Have you ever wondered how someone like Warren Buffett actually picks a company apart, in the real world? Well, today we're going to do just that. We're taking a real-world tech company, Trimble Inc., and we're going to run it through Buffett's famous playbook, step by step.
See, it all boils down to this one big question. But look, we're not just here to talk about one company. We're learning a whole philosophy. By the time we're done here, you're going to have a super powerful framework to look at any business, just like one of the greatest investors of all time. And the secret? It's not some crazy complex algorithm. It's actually a pretty straightforward four-part test. First, you look at the business itself. Then, the management running it. Third, you dig into the financials. And finally, you look at the price. Simple, right? We're about to put Trimble through this exact same ringer.
Okay, first up, the business. We need to figure out what Trimble actually does. But more importantly, does it have a real lasting competitive advantage? What Buffett famously calls an economic moat. So what is Trimble? Well, they've been around since 1978, and they make these high-tech positioning and data systems for huge industries like construction, farming, and transportation. But here's the really crucial part. They've made this incredibly smart shift from just selling you a piece of hardware one time to bundling it with software that you subscribe to, and that recurring revenue changes everything. And that software is key to their moat. So what's a moat? Just think of a medieval castle. The wider and deeper the moat, the harder it is for invaders to get in, right? It's exactly the same in business. A moat is any advantage that protects a company's profits from the competition. So where does Trimble's moat come from? Well, it's built on something called high switching costs. Think about it. Once a giant construction company or a massive farm gets all of Trimble's gear and software integrated into every single thing they do, trying to rip all of that out and replace it with a competitor system would be a nightmare. It's expensive, it's time-consuming, and it's risky. It's just too painful for customers to leave. And you want to see proof of that moat? Here it is. Over half, 51% of Trimble's revenue is recurring. That's not one-time sales. That is sticky, predictable subscription money that comes in month after month, year after year. That is a beautiful thing for an investor to see. All right, on to test number 2, management. You can have the best business in the world, but if the people steering the ship are making bad decisions, you're going to sink. So we have to ask, are the folks in charge making smart choices with the company's money? And for Trimble, the management report card looks pretty good. First, they have a solid reputation. No big scandals. They're also smart about how they use their cash, buying other companies that actually fit their main business and buying back their own stock. And crucially, they stay focused. They're not chasing every hot new trend. They stick to what they know. Okay, so we like the business and we think the management is solid. Now for test number 3, the financials. It's time to pop the hood and look at the hard numbers to see if this engine is actually running smoothly. First up, let's talk profitability, specifically return on equity, or ROE. This basically tells you how good the company is at turning shareholders' money into profits. Buffett loves to see this number consistently above 15%. Trimble, they're sitting around 9.5%, so they fall a little short of that gold standard. What about debt? Now, Buffett usually prefers companies with almost no debt. Trimble carries a moderate amount. But here's the key. Can they handle it? You bet. Their earnings cover their interest payments more than 8 times over. That is a very healthy sign. No problem there. Now, when we look at their margins, you can really see that business shift we talked about. Their gross margins are strong and getting better. That's the high-profit software kicking in. Their operating margins, though, have been a bit more up and down. That tells us there's probably some room to get more efficient. But here's maybe the most important number of all, free cash flow. This is the real cold, hard cash the business generates. The money management can actually use to reinvest, buy back stock, whatever. And Trimble is an absolute cash machine. That cash flow is strong and, even better, it's growing. That's exactly what you want to see. So that brings us to our final test. And honestly, this is the one that separates a good investment from a bad one. We know it's a good company, but what is it actually worth? And is the market offering it to us at a good price? So before we even look at the stock price, we have to do our own homework. We need to calculate what we think the intrinsic value is, a conservative estimate of what the business itself is truly worth, based on all the cash it's going to generate in the future. So after running the numbers and being pretty conservative about it, we land on an estimated intrinsic value for Trimble that's somewhere in the ballpark of $55 to $65 per share. That's our yardstick. Okay, so that's our number. Now for the million-dollar question. What is Wall Street actually charging for this company today? And the current market price is right around $60 a share. So now we can put the two side by side. And when you do, it's crystal clear. Our value is somewhere between $55 and $65, and the price is $60. It's trading right smack in the middle of what we think it's worth. And that means there's no significant margin of safety. That's the discount Buffett always demands. It's the safety net that protects you in case you're wrong about your calculations. And right now, with Trimble, that safety net just isn't there. So, we've put Trimble through all 4 tests. We've looked at the business, the management, the numbers, and the price. What's the final verdict? You know, there's a classic Buffett quote that sums this up perfectly. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Trimble seems to be a wonderful company, but it's trading at a fair price. And that leads us to a pretty straightforward recommendation. Hold. If you already own shares, it's a great business to keep holding. But if you're looking to put new money to work, the price today just doesn't offer that compelling bargain you're looking for. And really, that leaves us with the most important lesson of all. We found a wonderful company. Now the trick is having the patience to wait until the market, in its infinite wisdom or foolishness, decides to offer that wonderful company at a great price. That is the art of investing.